If I gave you $1 million right now, what would you do? Would you invest it? Buy your dream house? Travel the world? Or would you do what most people do? Walk into a bank, open a savings account, and leave every dollar sitting there? Because that feels safe. After all, that's exactly what banks are for, right? But here's a question almost nobody asks. If keeping millions in a bank is the smartest financial decision, then why don't many wealthy people do it? Why do successful entrepreneurs, professional investors, and many millionaires keep only a fraction of their wealth as cash, while the rest is constantly moving? What do they know that everyone else doesn't? Now, before we go any further, this isn't a video about banks being bad, because they're not. Banks protect your money. They process billions of transactions every day. They help people buy homes, start businesses, and safely manage their finances. Without banks, modern life would look completely different. So if banks are so important, why would someone worth $10 million, or even $100 million, choose not to leave most of their fortune sitting in a savings account? The answer has nothing to do with safety. It has everything to do with how money works. You see, most people believe the purpose of money is to be saved. The wealthy believe the purpose of money is to create more money. That single difference changes everything. Imagine hiring 100 employees, then asking 90 of them to sit in an office, doing absolutely nothing. You'd still be paying them, but they wouldn't be producing any value. No business owner would accept that. Yet millions of people unknowingly do exactly that with their money. They work hard to earn it. Then they leave it sitting still for years, watching the number in their bank account grow, believing they're becoming wealthier. But are they? Or are they confusing saving money with building wealth? Because those are not the same thing. And understanding the difference may completely change the way you think about money forever. By the end of this video, you'll understand why many wealthy people treat cash differently, where they actually keep most of their wealth, and the biggest financial misconception that quietly costs ordinary people thousands, sometimes millions, of dollars over a lifetime. So before we talk about investing, businesses, or real estate, we need to understand the mistake almost everyone makes the moment they see a large bank balance, because that's where the story really begins. Imagine opening your banking app. The screen lights up. Your balance says, $1 million. It feels incredible. You smile. You feel secure, maybe even successful. Because to your brain, a bigger number means you're richer. But here's the question. What if that number is telling only half the story? Your bank balance tells you how much money you have. It doesn't tell you what that money can actually buy. And that's a very important difference. Let's imagine two people, David and Michael. Both receive $1 million on the same day. David deposits every dollar into a savings account. He checks the balance every week. The money is safe. Nothing changes. Michael also keeps enough cash for emergencies. But instead of letting every dollar sit still, he starts thinking about where the rest can grow over the next 20 years. 5 years pass. David opens his banking app. The balance looks almost the same. Maybe it's even slightly higher because the bank paid interest. He feels relieved. Nothing was lost. Meanwhile, something invisible has been happening every single day. The price of groceries has increased. Homes have become more expensive. Insurance costs more. Airline tickets cost more. Even the cup of coffee you buy every morning now costs more than it did a few years ago. David's money never left the bank, but the world around his money never stopped moving. That invisible force has a name. Inflation. Inflation doesn't take money out of your account. Instead, it quietly reduces what every dollar can buy. Imagine filling your grocery cart today. Now imagine buying those exact same items 10 years from now. There's a good chance you'll pay much more. Not because you're buying more, but because each dollar has less purchasing power. That's why many wealthy people don't measure their wealth by looking at their bank balance alone. They ask a completely different question. Is my money growing faster than the cost of living? Because if the answer is no, then standing still is actually moving backwards. And that's the biggest financial trap most people never see. They believe safety means keeping money still. The wealthy believe safety means protecting their purchasing power. That small shift in thinking changes everything. Because once you realize cash slowly loses value over time, you stop asking, where can I keep my money? And you start asking, where can my money keep growing? That's the question that leads us to the biggest difference between how average people think and how wealthy people think. So, if cash slowly loses purchasing power, why don't wealthy people simply spend all of it? Because that's not the answer. The goal isn't to spend money. The goal is to give money a purpose. This is where the mindset completely changes. For most people, money is the reward. For the wealthy, money is the employee. Think about that. When you receive your paycheck, most people ask, how can I save this? The wealthy ask, how can this money work for me? Those are two completely different questions. Wealthy people don't see cash as wealth. They see it as potential waiting to be turned into something bigger. Of course, that doesn't mean every dollar should be invested tomorrow. You still need an emergency fund. You still need money for monthly expenses. Businesses need operating cash. Families need financial stability. Cash has an important job. But once that job is covered, the next question becomes incredibly powerful. Where can the rest of my money become productive? Because the wealthy understand one simple truth. Money that sits protects today's lifestyle. Money that works has the potential to build tomorrow's wealth. And once you start thinking that way, a savings account no longer looks like the finish line. It becomes the starting point. So where does that money go next? The answer isn't a single investment. It's an entire system designed to keep money working. Day and night. 24 hours a day. Even while its owner is asleep. So, where does the money go? If many wealthy people don't leave millions sitting in a bank account, where do they actually keep it? The answer is surprisingly simple. They move it into assets, not because assets are guaranteed to make them rich, but because productive assets have the potential to create value over time. Let's start with the first one. Businesses. Many wealthy people own businesses. Sometimes it's a company they built, sometimes it's one they invested in. Either way, a successful business can keep generating income long after the original investment was made. It sells products, provides services, earns profits, and those profits can be reinvested to help the business grow even further. Now compare that to cash sitting in a savings account. One waits, the other works. Next comes something almost everyone has heard about: stocks. To many people, the stock market looks like a giant casino. Prices rise, prices fall. News headlines create panic. But long-term investors see something completely different. When they buy a stock, they're buying a small ownership stake in a real company. A company that employs people, creates products, serves customers, and earns profits every single day. If that business continues growing over the years, its value may grow too. Some companies even share part of their profits with investors through dividends. In other words, your money is helping businesses expand instead of sitting idle. Then there's real estate. Imagine owning an apartment building. Every month, rent checks arrive. That income helps cover expenses. Anything left becomes profit. At the same time, the property itself may increase in value over many years. One asset, two possible ways to build wealth: monthly cash flow and long-term appreciation. Finally, there are bonds and other income-producing investments. They usually grow more slowly than stocks, but they can provide greater stability and predictable income. That's why many wealthy investors don't rely on just one asset. They build a balanced portfolio. Some assets focus on growth, others produce income, others help reduce risk. different jobs. One goal: building long-term wealth. Notice something interesting. Businesses keep serving customers. Rental properties keep collecting rent. Companies keep selling products. Bonds keep paying interest. Whether you're working, sleeping, or spending time with your family. Many productive assets continue doing their job. That's the biggest difference between cash and assets. Cash protects value. Assets have the potential to create value. And once wealthy people understand that difference, their question changes forever. They stop asking, "Where should I store my money?" and start asking, "Which asset can put my money to work?" Because over time, the people who build the most wealth usually aren't the ones who save the most cash. They're the ones who own the most productive assets. And that's where the real magic begins. Because once those assets start earning money, something incredible starts to happen. Your money begins earning money on the money it already earned. This is where everything comes together. The wealthy don't become rich because they found a secret investment. They become wealthy because they understand one powerful principle: compounding. At first, it doesn't look impressive. In fact, it can feel painfully slow. But that's exactly why most people underestimate it. It's like planting a tree. The first few years, it barely changes. But once it's fully grown, it produces fruit year after year. The same money, working harder with every passing year. But here's something many people misunderstand. Does this mean wealthy people invest every dollar they own? Not at all. In fact, many keep a healthy amount of cash available. Why? Because opportunities don't send invitations. Markets fall. Businesses go up for sale. Real estate becomes available at attractive prices. When those moments arrive, cash provides flexibility. This is called liquidity. Liquidity means having money ready when you actually need it. Not because cash creates wealth, but because it gives you choices. And that's a huge difference. Many beginners make one of two mistakes. Some invest every dollar they have. Then an unexpected expense arrives. A medical emergency, a job loss, a major home repair. They're forced to sell investments at the worst possible time. Others make the opposite mistake. They become so afraid of risk that they never invest at all. Their money stays safe, but it never reaches its full potential. The wealthy avoid both extremes. They don't choose between cash and investing. They use both. Cash protects today's needs. Assets help build tomorrow's wealth. Because in the end, building wealth isn't about finding one perfect investment. It's about giving every dollar the right job, at the right time. And that's the lesson most people spend decades trying to learn. The rich simply learn it earlier. Let's go back to the beginning. Imagine I hand you $1 million today. The question was never, where would you keep it? The real question is, what would you ask that money to do? Because that's the difference between saving money and building wealth. Most people see money as something to protect. The wealthy see money as something to deploy. They don't ask, how much cash do I have? They ask, how many of my dollars are working right now? That's a completely different mindset, and it changes every financial decision that follows. Now, let's be clear. This isn't about avoiding banks. Banks are essential. They're the right place for your paycheck, your emergency fund, your monthly expenses, and the money you'll need in the near future. But if every dollar stays there forever, it only performs one job. It gets stored. Wealth, however, is built when money has the opportunity to become productive, when it owns businesses, when it owns real estate, when it owns shares of companies, when it earns income, when it compounds over time. That's why many wealthy people don't measure success by the size of their bank account. They measure it by the value of the assets they own, because assets can continue creating income, even when they're not working. Think about it. You can only work so many hours in a day. Your money doesn't have that limit. If it's invested wisely, it can keep working 24 hours a day, 7 days a week, year after year. That's one of the biggest advantages of long-term investing. So here's the lesson I want you to remember. Cash is important, but cash alone rarely creates lasting wealth. Keep enough money to protect yourself. Prepare for emergencies. Sleep peacefully at night. Then ask yourself one simple question. Can the rest of my money be working harder than it is today? That single question can completely change your financial future. Because the goal isn't to have the biggest bank balance. The goal is to build assets that continue growing long after you've earned the money to buy them. And that's exactly how many wealthy people think. Not because they're smarter, not because they have a secret, but because they understand one timeless principle. Money that works has the potential to create more money. If you enjoyed this episode and learned something new, subscribe to Budget&Grow for more videos that simplify the world's biggest financial concepts. And if this video changed the way you think about cash, share it with someone who believes wealth is measured only by the number in a bank account. Because sometimes, the biggest financial advantage isn't earning more. It's simply learning how to make your money work for you. Thanks for watching. I'll see you in the next Budget&Grow episode.